Hey, this is the Eye of the Storm podcast with the big picture technical outlook for the U.S. Treasury markets. Today, I intend to cover the 30-year bond futures market and also the yield charts, the 10-year note, the 5-year note, and the 2-year note, and also from the futures market basis and the yield charts as well. So starting here on the 30-year bond, I'm beginning on the weekly chart, and it's a 20-year weekly chart, and I've kind of opened it up. So we're basically just kind of taking a look at from the highs. So from the bond price high, the yield low, and what ground we've covered thus far. So what I continue to count on the 30-year bond, and basically through all of the Treasury markets at this point, is a 5-wave decline off of the bond price high. And again, that was back in, I believe it was August, beginning of August in 2020. And it was pretty much right when we started to get rate hikes, or the market perceived that the rates had reached their lows. And so the bond prices had then reached their highs. And so we started to see a decline in the bond market. And what, on a technical basis, what we're working through is an intermediate A wave down. And it is turning into 5 waves down. And where we are within all of that is we've now seen minor wave 1, 2, 3, 4, and we're in that minor 5th wave, which, similar to the minor third, is promising to be just as wild and crazy as that 3rd wave was, which took us down to the October 2022 low, both in bond price, but also at that level. That is where the equity markets also bottomed to put in a primary A wave. So the count is a little bit different here in terms of this is not a primary A wave. It only completed a minor 3rd wave. Now, I could review and possibly just fit that this is intermediate A, intermediate B, intermediate C, and put a primary A wave underneath that. And then this would be an ABC, primary B, and we're in a primary C wave. But that would just reflect that both the bond market and the equity markets are moving at the same degree level. And that is where I would not agree. So that's why I'm keeping this up here as a primary 5th wave. And that was a longer term rally phase on a primary degree. And I tend not to go much above that. So to go up into a cycle degree in bonds. So as high as I go is a primary, and now we're starting back on this ABC of intermediate degree down. So that trend is down. So what is going to be an intermediate wave A would be down. Intermediate wave B will be a counter trend rally. And then we have an intermediate C wave down. And those should coincide. They may not be point for point, low to high coincide, but they should coincide with the equity markets going through also a larger degree. So they're doing it on a cycle degree ABC, to form a supercycle wave 4 correction. So again, being that this is a corrective process within the interest rate markets. So again, it's getting that ABC in bond price, it's going to be down. In yields, it's going to be up. So we're going to see on the yield chart, we're going to see a counter trend decline, because the trend right now in interest rates in the yield is for higher yields. So again, this is over a longer period of time. So I'm going to get back to this chart. Now, we started the minor fifth wave down, began in April. So on April the 3rd is where we reached the 30-year bond futures high, and that was at 134.14. That put in a wave 4. So it was an ABC up, putting in a minor wave 4. We started a minor wave 5 down. It will consist of 5 waves of minute degree, of which we had 1, 2, 3, I believe is what we've just completed. Now, initially I had on a daily chart marked it where we very well could have completed minute 5 and then put the minor 5 underneath it and put the intermediate wave A. But upon reflection and moving back out to my weekly, my 20-year chart, it did not fit as cleanly. And so taking a look at on the weekly chart, I get a 1, 2, 3, 4, 5 for 3 versus that was 1, 2, 3, 4, and then this would have been a 5. Now, this move itself, high to low, was pretty much 5 waves. So I'm marking it still as completing just a minuet wave 5 to complete the minute wave 3. So you can see there's a little bit of a change. That's where it took place. Now, I'm going to bring this down to the daily chart because last week, we saw some, let me just go one more time up to that weekly chart so I can show it. And let's get that opened. And one more time. This is last week. So the market topped at 117 last week. I believe that was on Monday. And then spent the balance of the week tumbling head over heels down a very steep slope. And the market bottomed on Thursday of last week at 112.10. And it was an incredible decline. And it was just like, get out, get out, get out, get out, get out. There were a lot of factors that went behind it, but the market did seem to put in a low and just jackknifed off of that. They just V bottomed off of that 112.10 low. So I'm going to go down to the weekly chart, and you can see it right here. There's the 110, let me get back over there, the 112.10 low, and it just zipped right back up in one day to finish that day at 113.27. So it almost got back to 114. And then on Friday, it did. It traded up to 114.24 to close back. And then from that level, it sold all the way back down to 113.12, finishing off at 113.30. So it continues to be an extremely volatile market in terms of the speed of which it's just flipping around. I did happen to notice also at towards the end of the week that within the 30-year bond, there was increased volume on both the buy side and the sell side. So it got a little bit crazy as the market continues to just try to determine what should be, what the position should be. So again, end of quarter. So it was the end of the second quarter, end of the third quarter. And so we are going into the fourth quarter of the year. And so we get a lot of position squaring, a lot of shifting around. And what do they want to hold on to? What do they want to go into? And it almost appeared that between all the markets, the yield curve has just been inverted for such a long time that we basically are just accepting it as that's the way it is. And that's not, I don't think, in my opinion, the correct way to really look at it. But in any case, it is kind of what. But I started to see what I thought would be an attempt to narrow that inversion, narrow the gap, and how much room they're going to get out of that, exactly what's going to happen, is yet to be seen. But it did seem that was really kind of coming in just a little bit during the week. And that could have been just because of the shuffling around of positions and where they were being moved out to. Now, what I believe on a technical basis that what we could be going through here is, again, if this is just a third, then we're going to get a fourth wave. Fourth wave will correct to the upside. So it's going to be a counter trend rally. So first thing I'm going to do is I'm going to put in our fibs here, and I'll stick it there and down to this low so that we can see. And now I'm going to clean it up. I'm just going to put on what becomes pertinent to this particular move. So 236, yes. 618, actually no, it's a fourth wave. So I'm actually going to even take out the 618. And so under Elliott, one of the guidelines that Elliott left for us and continues to be valid is that the fourth wave will usually find its terminus, its endpoint, within the price territory of the fourth wave of one lesser degree. We're in a minute degree that would put us in. This would be the fourth wave, and that's where we would be expected, the market to kind of come into. What's going to rattle or just rally right around is we have the 0.382, which on a Fibonacci basis is the most common retracement level for a fourth wave. So that comes in at 120.07. Now, we closed below 114. So we're looking for a 6-point drive higher. Now, again, I'm looking at a daily chart. I'm not expecting that this is just going to unfold in the next few weeks, but actually, I believe that it will. And here's why. We still have a Fed which is battling itself in terms of what should be coming in interest rates. And we're not getting a lot of really reports that inflation and et cetera, a lot of those measures are continuing to show improvement. So again, a lot of it also, I think, came through with the potential that we could have the government shut down later tonight, actually. And so that's still out there. I know because I'm following along with everybody else, basically what is kind of going on, that the House passed on a bipartisan basis, because they had to get the Democrats in there, but they did pass a stopgap funding for 45 days. And so, but that has to get through the Senate. So this is still up in the air. And so I think that also put a lot of pressure on the bond market, because we already know that out there is that there's already been a threat. And I think it was Morningstar, it might have been one of the other rating agencies, talked about that, the government shutting down will affect the bond ratings that are made by Morningstar, Fitch, S&P. So again, and it's because if we remember that the last time that there was an adjustment lower, right? They lowered the rating, was due to the congressional brinkmanship. That was the exact word I believe that they used. So are we seeing anything different? No. We're seeing this play out in the House of Representatives. So again, this still could happen. And that will throw a tizzy out there in terms of what happens to the bond price, what happens to the yields. And so the government, in order to fund our needs to run the country, will become greater. People aren't going to be giving them, oh, here, you can take my dollars. Like, you use my dollars to go fund the government. And yes, I'll take a lesser rate, because the good faith and the credit of the United States will become jeopardized. In any case, back to the technical picture. But basically, I'm adding this in because it is having an effect on technically what we're seeing, because technically we could expect a much stronger rally right now. It is a fourth wave rally, so we're giving all the technicals of where it should come up to. But the reality really sits in, it may not get further than where it started last week. And that's the 117 level. And that comes in 0.236. And it's still basically pretty much a 5-point rally from the low that we had last week. So if we rally back in 3, get it back up here, that may take us through the first 2 weeks in October. Then we're beginning earnings. Then we're beginning, okay, what about the Fed meeting? All right. We know that more than likely we have one more hike. We know from all the Fed governors that they basically said, look, we know what we said, but we're going to do another hike, and we can't really speak, but we're going to have more hikes in 2024. So again, we are still working towards a bond price low, right? So we need to look at, well, what comes next if we're still looking for additional downside, and I get a 4 and I still then need a 5. The first thing would be is that I will be able to once a fourth wave is put in, I again could put in the Fibonacci extensions when I compare minute wave 5 to minute wave 1. Those aren't available right now. What we had from minuet wave 1 to minuet wave 4, and those basically came in right on target at 112.10. So again, that part continues to work out. But if we're looking at minor wave 5, the 100% mark is 104.11. And previously I thought, okay, how is it really going to get down there? What's going to really drive it to drop this thing? Basically, from where we are, 9 points, but from the low, we're looking at 8 points. So pretty much to the number. There again, quite a few things out there. And a lot of it is revolving on the Fed. A lot of it is revolving around inflation. A lot of it is revolving around wage inflation, because we can't forget that what we still got going on out there is now we got the battle, and more unions are coming out and going on strike. It's now going, we had it through the United Auto Workers. Those strikes are increasing. We saw the Hollywood writers, that guild won. And so that strike is over, but they're not necessarily going to go back to work until the other factors are all Screen Actors Guild, that they come to terms. And so that strike basically continues. We're seeing where hospital workers across the country are now considering strike action. Besides the United Auto Workers, we're seeing that. And now we're seeing that some of the airlines, that the pilots have decided that they're going to go out on strike, and that'll hit Delta. That the United, I believe, just came to an agreement, but we're seeing the unions coming forward and saying, hey, you guys are making more money and you're keeping it to the upper sea level, and that's not going to work. And so we're getting all those negotiations going. So as these strikes may roll out, how are they going to affect? Wage inflation will affect interest rates. We know this already. So again, here we are confronting what could drop us down to those levels just in the bond market. And when we take a look at, we know that, and I'm going to go back over. So we have that 104. We're looking for that. I can bring it down one more. Let's take a look at the 4-hour chart, and we can continue to see where are we within this. Well, we just kind of got, if anything, this kind of looks like an ABC, and then you see it just zipped itself back down, came back up for the close. So if anything, I got one more little dip before the wave 3, because I'm telling you, if that's going to be a minute wave 4, which I do not think that it is, we are in some serious trouble. If this is the minuet, and no, it just does not fit. So if anything, we have one more dip to complete minuet wave 5 and minute wave 3. Then we still would expect, I still would be expecting this larger flip higher. Now this could be A, this could be B, and we will get a stronger rally, which could bring us back up to 115, eventually back up to 117. Again, on a 3-wave basis, it would fit. So again, we got to wait. We got to see how it's all going to play out. Now, over in the yield chart, we already know that what the government or what the Fed has been targeted 5.25, 5.5. And that's just on the Fed funds. Okay. So what we've done so far here, this is like not necessarily right. This has got to go up here to 4. Hold on 1 second. I think I did that based on that I put these on a line chart on the close, but even that was wrong. All right, so let me put in one quick correction. Is going to actually come in at 4.8, which was the high that we saw. I'm not sure why my computer did not pick that up, but quick corrections. All right, so 4.8. And that, again, and we're looking for, if we're going to get away 4, let me clean this one up because there's a lot of the levels on there which do not matter. So wave 4. It'll be basically, these are what we're looking for, possibly. So again, here we are in the yields. We got to 4.8. I believe if they, and then on the upside, I think I still have them out there. No, I took them off. So they should be. How far up are they? Okay, hold on 1 second. Oh, yeah, it came off. Because I'm looking for the 4, so I took the other upside off. So here on the daily, we have the 4.8, and this is just the contract difference. So that's why it was like 4.726, because, but I now got it to that high to correctly show on the 4-hour chart where we can come down to. So, and it was a spike, but you see there, it was a close. So here we are. I know it's confusing, but interest rates have been. And so when we're trying to just work through the smaller moves, again, it gets really kind of squirrely. So again, 1, 2, 3 on a minute degree, we're inside minor wave 5. I need a minute 4 and a minute 5 to complete that. We still have likely one more interest rate hike this year. We still have a lot of things to factor in to see what is actually as we start to roll out. Again, once this minor 5th and the intermediate A is done, my expectations would be that we would get a intermediate B wave counter trend decline in yields. So I would expect the interest rates would begin to soften a little bit. They would be maybe even not necessarily see a rate cut, because again, this is going to get real tricky, because I think the pressure remains on the Fed to control rates and the money flow, and to clean up their books and to be on top of what is actually happening out there in the real world in terms of inflation, etc. So, but I can only go by what my technical picture is telling me right now. And then as it rolls out, adjustments on my end would be, to adjust numbers and the scale and what we're seeing and what we're going through. But initially, on a straight technical picture, I'm looking for a minute 4th wave. So almost basically, it does look like it's in play right now. But the 30-year went from 4.8 really only down to 4.665. And technically, that's right where the 20, the 4-hour 20 is kind of crisscrossing. So it met the decline, stopped, and we rallied up off of that. Now, coming off, bare bones minimum, we'd be looking for it back to 4.5, 4.5 on the yield. Coming in its way, we have the 50, SMA and EMA, and they're both at 4.5, 4.4, 4.6, 5.4, 5, yes. Woo. Talking all this slight small number, 4.555 to 4.544. So a very small difference there between the two. But so basically we have at 4.5, we got the 50s, and we have a fib down at the low end of exactly 4.5. So that I'm kind of thinking, yep, that could be pretty clean. If we're still looking at that the rates will increase come the end of October, or we continue to deal with everything that's happening in Washington in terms of the government being able to fund itself, which affects, Treasury being able to issue bonds, Treasury being able to, create, not necessarily create, but just continue to fund the government, really puts a lot of pressure on the bond market. So, and also the dollar. So we got a lot going on. We got a lot going on that's really going to affect everything underneath it. Because if you remember, again, my own pecking order, so to speak, is that what sits at the top are interest rates. And underneath that, interest rates are then bonds, and then currency, and then corporate, which is, our equity markets, and then retail, which is just you and me, folks. What we end up paying, how does it affect us? Where are our increase? We're consumer price. What are we paying more for? When we're seeing the things happen and United Auto Workers, how's that really going to affect autos? Well, they're not going to be making them. They're out on strike. So the inventories drop. So is this inflationary, deflationary? How does all this fit in? And it will, and it'll show up in the numbers. And the market cannot ignore reality. It tries, but it can't ignore reality. And the sensitivity within the interest rate market is really visible. And we're seeing it as huge traders and firms and everybody in between is coming in to make adjustments to positions. All right, so technically 4.5 on a pullback. It has more additional moving average support. Again, this 4-hour chart has more moving average support down at 4.426. And then the 382 level is 4.3. So I'm not really looking for it to come much below that, although the previous fourth wave, it would be into that price territory. 4.3 is right into that price territory. The low of that wave 4 is here, 4.1. Could it get that low? Yes, technically, if we're following Elliott, yes, it could. Am I anticipating that right now? Not under the current count. It would be pretty deep, although I can't say no, that it won't happen. So, and if it got down there, then the equivalent on the bond price would be, pretty nice rally above 117 and up towards that 120 level. Okay, see how those two work? All right, so that's the 30-year. Let's go down to the 10-year note, starting again in the futures market. And basically, same deal. Here we have the top of wave 4. Let me just pull that out to the daily. We'll look at it on the daily chart. I'm going to keep it here on my line chart, just makes it a little bit cleaner. And most of my fibs are set up to that. And this is on a closing basis versus catching all of the intraday extremes that we see on the candlestick chart. We got a little bit of an extreme there, and I'm not including that on my close because I take it on the close, just cleaner, and easier to see the actual count. So here we have minor 4. That was back in May of this year. We topped out at minor 4. And then we got 1, 2, and the third. Again, the 10-year was actually almost cleaner because I was putting it 1, 2, 3, 4. And then because this actually was 5 waves down, I was putting the 5, but the minute wave 5 here, the minor wave 5, and the intermediate wave A. And then I took a step back and came here, looked at it on my weekly chart, and that's where I thought, no, actually, I'm going to go out one more, go out to my 20. I was like, no. And you can see here that it's just like 1, 2, and then 1, 2, 3, 4, 5, 3. So that's where I got caught. I thought, no, because I'd have to really pull this 1 down. So it was easier just that this is 1, 2, and then we had another small 1, 2, and then a 3 and a 4 and a 5. And that was the minute third. So back down, let's go to the 4-hour chart and take yes. We'll just open this one up. So now we're looking at what we've got going on in terms of the bond price. We're looking for a fourth wave, uptrend rally. Now, straight fibs, we got to connect it from here to here. And so right off the bat, let me just clean up to what is not actually going to come into play. 2, 3, 3, 2, 2, 6, 1, 8, 6. We're going to take those two off. And basically, we're looking at 0.236 to 0.50. And at that top of 0.50, that is where the previous fourth topped out. So that's what I'm looking. That would be top side. But we still have that one last possibility that we got one more swing lower, put it in the third, and then run up. I don't believe that, again, I don't want to say never. So I'm leaving it out there as a possibility, and that would just lower this level for minute 3. But the levels, the next levels down for here's the 100%. Now let me just pull this back out to the daily. Here we have minor 4, 100%. Minor 5 would equal 100%. Minor wave 1 right there at the low. It's already done. On if I just come back over and just use the candle, look what it did. This was Thursday. 107.085. 107.085 was the exact low, and that's where my minor wave 5 would equal minor wave 1. Then when I came back out and I started to recount, I was like, no, it's really looking like it may come in between these levels, right? So, and again, on this minute minuet level, minuet 5, it was also 100%. Right here, a little bit higher. So yeah, I had two 100% meeting up at that level. I was like, wow, okay, so maybe this is the completion point for that intermediate wave A, and we just start rallying from here. And then I caught it and I thought, it's going to be really hard for the market to rally in the face of one more rate hike, in the face of a government shutdown, or just the Washington troubles, just everything that's kind of happening around the country, all of the strikes. How's that going to affect? What are we going to be doing here? So that combined with the actual weekly showing that it likely was, it is a 5, but I had to move the 3. And from minute down to minuet level and putting that minute 3 here. So that gives us that additional rally and then drop for minute 5. Then we're into the minor 5. So what I got still coming out here would be, once we get it in, would be to, once minute wave 4 is complete. And again, we're looking at 109.025 to 110.050. And we got moving averages galore in between. So I think it should be a very bumpy ride if it's going to try to get itself up, even at this high, getting inside this fourth wave. I think it could be an extremely bumpy ride. But what this extended count did, cleans up all this noise. And that's really what it was. It was the subdivisions of the thirds. So, and it was messy, and the 10-year note, messy and difficult. We had massive rallies on the hope the Fed wasn't going to cut, the Fed wasn't going to raise anymore. And they did. They did. And that just knocked out the hopes. And then the reality set in, and then we got this major nosedive. So one more looking, it looks one more. We get the nosedive. Once wave minute 4 is in, And again, the alternate is that my alternate count on both the 30 and the 10-year would be that intermediate wave A is done. It's not going to be as clean, but if we start to get a move that just starts to go and we're heading way up to higher levels, then it's going to shift the count, obviously. But right now, it doesn't look like it's going to happen in that way. So I'm thinking in terms of 109 to 110 plus the change that we get there. We know we have 111 up here top side, and that coincides with the top of the previous fourth. So, and if I take it back down to the line chart, still, but closer to that 111.015. Now, and that 50% for a wave 4 doesn't break any rules, right? Minor 4 would not be overlapping minor wave 1. So still all possible. And it would be quite the rally, actually. And, you know, the one thing is that I do think is that the market is pretty short. So if we get a lot of switching going on and now we're going to go, oh, we better all get long, it could really just push. As we see, when the stronger bids were coming in, you know, the sellers are like, okay, we'll back off. And they did. Technically, we have to look at least into this level for minute 4, then we get a minute wave 5. I'll be able to put that in. Minor, we've reached this level, still holds. A break below technically drops that down to the next most common, which is 101.105. That suggests to me for us to get down there on the 10-year note, something really nasty's got to happen. But we can't say no. I can't say not possible. Technically speaking, that is possible. Okay, over in the 10-year yield, we got up to 4.68, actually 4.633. Let me go right to it. Oh, yeah, 4.683. That's been the high thus far. And again, same deal. So we have 1, 2 minute. I did have it where I could have put, I was putting the 3 here and the minute 4 here. And this is working into, it looked like it could have been the complete 5, maybe needing one more rally. And I thought, just stopped working. And so we got into that it was this third, the minute third, extended beautifully. And this is where, you know, again, we had a few problems. Those are the spikes. And they drive, and then they spike, and then they drove, and then they spike. So again, working it out, same deal. Minute wave 3 complete, minute wave 4. Now, if I'm looking for that minute wave 4, we had like a 4.9, but it'll be revised now. So I'm looking for the 4 so I can again put minute 1 to minute 5 and see where our levels come in. But from here, and depending on how low we get, again, even there we have moving average, we have support in the 4-hour chart at 4.496. Then we have 4.389. Then we have that fib at 4.341. So 4.3, almost 4, down to 4.3.2 or 4.3. There's substantial support, which could complete that 4th wave. Now, on a yield basis, 4.0, basically, is where the minuet 4 bottomed. And so we got to go. But inside, we're inside the price territory once we were to break below 4.34, 4.345. We're breaking below the high, so we're into the price territory. So all of that. So I'm thinking that we got some fairly strong support on the yield chart between 4.4 or 4.5 or so, 4.49 down to 4.31. And that's where I think we can get an ABC, and then we rally again. Once I get that minute 4, I put that extra layer, and then we would have that. Now, what I can put back on, and I got to keep going out to my weekly. See, that was the problem on my yield chart. I actually can't. So, because that's all the data I have. So I got to go back, but I can draw it from an outside source. And so I'll likely try to pull that together so I can put a level up here, and that would be for minor 5 as compared to minor wave 1. I just have to get that from a different level, and I'll be doing that hopefully during the week. But still looking for that pullback now, and then we have an additional rally. Once in, we likely are going to be reaching, I can just do, let's just take a guesstimate, as I call it. So if we have here, there is minute 1, and let's just say we come down to 4.3. Well, we got 4.8 up there. And if it's going to be 4.34, we're just going to be a little bit higher. Beginning, the end. What's this one? 4.308. Okay. And we're going to go up to 4.341. 341 and hit accept. And now we're at 4.9. So you can see how that kind of shifts around a little bit. Now that's guesstimates. We don't know. If it only comes down to here, we're going to be at 5%. So I'm going to take that off because these are guesstimates. So you can start to see that we still have that just under 5%, which has been in the picture for a while. All right, so quickly, zip down. Let's take a look at the 5-year note. Same deal, except we got some big stuff going on here. So this is a very difficult chart. So, but if I take it out and I go to our candle, even under my candle, I'll tell you where I have to far. Let me go to my daily. It's at the daily where I can get those July highs via, of course, it was a different contract. So when we're rolling in contracts, it does affect, but you'll see that's why, but I'm trying to just keep in line with what we can expect. So again, I'm using the line chart, and it just lines up cleaner with that candle here. And that's on my daily. When I come down to my 4-hour, it's way up here, but I'm leaving it there. So I get a cleaner level to where I can expect the minute 4. If I bring it all the way down, it just really kind of changes the numbers around. So this one, I could bring it down to here, and then it pulls these too low. And I like to, we're determining a previous 4th. And this is such a mess that it just becomes very difficult to try to determine where this all is going to sit, even when I bring it down to a line chart, because we have this very nasty looking, right? So here's my wave 1 is here. So the 2 and the 3. And then we have the 4, and the 4 should be 105, 257, 106, maybe. But then again, we'd be flipping over that. So it's really likely going to be held pretty low. Either that, or we're really working through a diagonal for that minor 5th wave on that 5-year note. A lot of volatility in the lower end of the curve. So, but here, 105, 257, 106, I'm not looking for 106 because it overlaps. I'd have to move it up to here. And I could. that would move the 2 up to here. It's going to push it all higher. I may do that. I'm not sure why I kind of set it up this way, but I may go back and make my adjustments there. I take this out to my daily chart. Pretty clean. 1, 2, 3, 4, 5, 1, 2, 3. Cleaner here. And this is cleaner, right? You bring it down to that 4-hour chart and you're like, whoa, isn't that messy? So sticking to the daily, still have all of our ifs, ands, or buts, but you'll see how it can come up to 106 and not overlap. So it becomes, but it can't go above. You know, this is 106.197. This is 106.100. It'd be a squeaker, but it can do it. So again, looking for a 4, and then we still have a 5. Again, I do have the levels here. And I said, why does it just really shift around when you move from charts? So I am going to try to fix that. This is 111, 100. Okay, so it's going to add a little bit more. And make these quick adjustments. And what's left now, right? Because if I add all the other numbers in, well, all we got left is 2.618, which is 103.132 on the 5-year note. And that would be the next projected low for minor wave 5, because the 100, 1.3, 1.68, 1.618 have already been exceeded. So I took them off because they're up sitting here providing blockage, you know, just to see what we have going on. So 5-year note, interesting. Looking at the 5-year yield, skyrocket. Now it actually closed lower, and it's because it just, this chart is not as updated as cleanly in the micro futures, because I guess I just don't trade enough, as the actual yield did kind of pull back off of that 4.75. So we already are starting in what I think is the 4th wave, and we have 4.5 and then 4.4. And so even if I just did quick from here to here, but I don't like this particular yield chart. But it does show that we're skyrocketing, you know, we're pushing. Now they're pulling back a little bit, and there would be pretty much no doubt that, again, this is the same chart. I can't get out far enough where I can get a wave 1. So same deal. But again, I know where I need to go to try to do that. But at least inside here, we can see that you saw straight up. Now pull back and one more. And I think that if they switch this around, where the Fed funds rates are going to be 5.5, 5.5, 5.75, we're going to see this 5-year note kind of climb, likely above 5. Last up, 2-year note. It's all been pretty crazy, and here very crazy, because we have minute 3, minute 4, I believe, already in. We're coming off in that minute 5th wave already, and so within it, we have minuets. Minuet 4 likely playing out. Remember I told you that narrowing of the inversion? So they're narrowing it up a little bit. Going to be felt stronger on the 10-year, on the 2-year. So, but still, this is the target. We haven't quite reached 101, but I'm looking for it to break below that 101.035, 033, to put in that new low. Doesn't have to go by much, but I'm thinking in terms of that it may. If not, are we going to put a 5 down here? Then we had a small failure, which would give a stronger indication that they're pushing, they're narrowing that in the curve. You know, the inversion between the 2 and the 10, that's the one that they use. So, and they're going to narrow that up a little bit. So here in the yield, See how we had a much bigger pullback off of the high. The high was 5.1. Well, let me just see what it was. 5.128, 5.168. So it got itself above 5, hung out above 5, and then on end of the week, boom, dropped under just below. So when we look at the chart, like, wow, that kind of really dipped in terms of the actual rate. You can see it went from 5.2 to 4.9. So it's 0.3. So yeah, big enough. But here again, it could be ABC already. So if we're looking for the 4, and this is like a 1, 2, 3, 4, we get that 5, we get up here. Again, 2 years going to feel it much quicker and move faster. If we do start, if they set the floor ceiling at 5.5, 5 3/4, where do you think that 2 years is going to go in a hurry? So again, it could be very quick. And then we're dealing with one more time where we likely have moved into finishing minor wave 5, intermediate wave A, and then we do start a counter trend decline. All right, that's going to wrap up the interest rate. It's not been easy. It's much clearer in our longer term. The short-term markets, 2-year, even down Fed funds, not that much fluctuation so much in the Fed funds. They're going to be more proactive about sticking to where the Fed's saying their targets are. So right now it's fluctuating between 5, 5.25, 5.5, and now they're going to say 5.5, 5 3/4. It's really going to shift, and we'll see that market shift, and it may start to do it via the December contract. So, as far as just what I look at the 30-year bond and the 10-year note, and that really kind of spells what I think is happening, at least at the long end of the curve. And so we're looking at where interest rates a little bit further out. And so that's kind of where the bulk of my analysis is kind of hanging into there. And it continues to show right now that bond prices still have additional downside, yields still have some upside to go before we get into that medium term counter trend, rally in the bond price, decline in the rates. Thank you very much for your attention today. And please just go ahead and leave any questions in the comment, and I will attempt to clarify anything. I know it's been a very confusing picture, and I know some of you are trading different products like TLT, TBT, Triple T. They're not necessarily products that I constantly look at on a daily basis, but I'm pretty much can get in there and start to try to relate some activity of what I think is going on. Anyway, have a great balance of the weekend, and we'll know more in terms of what the government's going to do or not do coming up in just a few hours.